Hello everyone, welcome back to our channel. Today's video is a complete deep dive into smart money concepts, how big institutions, banks, FIIs move the market, and how you can read their footprints on the chart. If you have ever wondered why price hits your stop loss and then goes in your direction, this video is the answer. Stick till the end. I will show you different examples, Nifty, Bank Nifty, and some stocks charts as well. So you will understand these concepts very clearly. But before clearly. But before we go further down into any advanced concept, so you should understand the market structure because the market is key for any concept that we are going to learn. If you are not aware of the market structure, how the market is going to behave, what are the patterns of the market structure, then any concept will not make any sense. So before we learn any advanced concept, you should understand how market moves. So in general, there will be only two ways where market is going to move. One is market makes higher highs and higher lows and move in this direction. And one is market makes lower highs and lower lows and market moves in this direction. So where the higher highs and higher lows, when the market is moving in direction, we call this as an uptrend. We call this as an uptrend. And when market moves in the downward direction by making lower highs and lower lows, we call this as a downtrend. But there will be another thing where market will struck in a range. It will make similar highs and similar lows almost. So this trend is called as a sideways trend. So if you are aware of this market structure, then all the concepts that we are going to discuss will make sense for you to understand, or else everything will go out of your head. So now in this, you should understand two things. One is BOS. What do you mean by BOS? And one is CHOCH. So BOS stands for breakout structure. BOS stands for a breakout structure. When this forms, when you will see the breakout structure on the charts, and when you will see the change of character. COH stands for change of character. So hope you understand this. What do you mean by BOS? And CHOCH is nothing but change of character. Okay. So when price breaks above the previous high, the trend is continuing. So that is called as a breakout structure. Now if you see here, this is the high and this is the low. And this is the higher high and this is the higher low. So when price is breaking its previous high here and making a new high, which is an higher high, then this breakout structure is called as a BOS, which stands for breakout structure. And price is moving in higher highs and higher lows. Suddenly you will see a price breaks previous low inside an uptrend. So now price is moving like this. Price have moved like this in upward direction. Suddenly you will see a change in the structure where price is going to break this higher low. So earlier it was making this low, this is higher low, and this is further higher low, and suddenly you will see a change in the character where price breaks the previous low, which is the higher low. The price breaks in an uptrend. It means that the price is changing its character. So this is an early warning that trend may be reversing. So this is called as change of character. CHOCH. This is called change of character. So you should know the market structure. You should know what is breakout structure. You should know what is change of character. So if you understand this, you will be able to understand the market in a right way. Breakout structure is nothing but the market is saying I'm still going up. Whereas change of character, market is saying that something has changed here. So be cautious. So trend may be reversing. So that indicates the change of character. So we should understand structure first, liquidity comes second. Without a clear trend, everything else is a noise. So first you have to understand the trend, what is uptrend, what is downtrend, what is sideways market, what is breakout structure, what is change of character. Then you will be able to understand the core concept of smart money. So where we are going to discuss fair value gaps. So this is what we just discussed. So what is the context? Market structure is the context, and this is the king where market, when it forms higher highs, higher lows, that is called as uptrend. And whenever it breaks the previous high, that is called as a breakout structure. And whenever it breaks the previous higher low, then that is called as a change of character. So when market changes its character, so that is an early signal for us to be cautious, and there is something changed in the price. Based on that, we have to take our decisions. So structure comes first, liquidity comes second. Now let's go into the concept called FVG. So you would have heard about FVG here and there in many of the channels, many of the YouTube channels, or somewhere you have read some book and you have heard this FVG. What is FVG? FVG stands for fair value gap. FVG stands for fair value gap. So what is this fair value gap? So how this fair value gap is going to form? We'll just understand that the basic concept, how the fair value gap is going to form. Suppose market is going in a uptrend. Suppose market is going in a uptrend and suddenly there will be three candles here. The basic concept of fair value gaps is you have to consider three candles. Candle 1, candle 2 and candle 3. When there is a gap between first candle high and third candle low. So between third candle low and first candle high, if you see a gap, so this gap is considered as FVG. This gap is considered as fair value gap. In generally in market, very rarely you will be able to see this fair value gap. Usually price is going to fill like this. So this is the candle 1, this is the candle 2, and this will be the candle 3. This is how the candles are going to form. There will be no gap between first candle high and third candle low. Sometimes you will see a gap between first candle high and third candle low. So this gap is considered as a fair value gap. Again, when I say first candle and third candle, it does not need to be day's first candle and day's third candle if you are trading an intraday. Okay, so suppose if market is going like this, market is going like this, and somewhere you will see a gap between the candles here. So you can consider this as a candle 1 and this as a candle 3. Whenever you see a gap between its previous first candle and the low of this candle, then this gap is considered as a FVG. We will go on the chart and see examples as well, but the basic concept how you have to identify the FVG is candle 1 high and candle 3 low. If there is a gap between these two, then that gap is considered as a fair value gap, and this is called as an imbalance zone. This is called as an imbalance zone, and this also can be called as void, imbalance zone or void. Because why these gaps are going to form? When institutions place huge orders here in this candle, price moves so fast, normal buying selling is skipped, then the gap is going to be formed here. So this gap is called as an imbalance or void. Because normal trading was skipped there, unfilled orders are going to sit here. In this fair value gaps, you will have unfilled orders. Unfilled orders are going to be inside this fair value gap. Price acts like a magnet. Even price goes upside, price will act as a magnet to come back to this fair value gap and fill these orders which are pending here. When it fills the orders which are pending here, then price is going to jump upwards. So that the price will initiate whatever orders that are pending here, and the price will move again back into the upward direction when these orders are getting executed. So we don't need entire gap to be filled, just 50% mark is also okay. So suppose if there is a gap here, sometimes price will come, test here, and it will run away. But most of the times price comes inside 50% of this fair value gap, test here, and it will move upside. So that will be our entry. So whenever price comes here and test this 50%, that will be our entry zone. So imagine like a ticket counter. Suppose there is a ticket counter here and there is a queue here. People are standing in the queue. Just I am giving simple analogy for you to understand the fair value gap. This is a ticket counter. People are standing here in the queue. If a VIP walks in, so let's assume this person is a VIP. Okay, if VIP walks in straight away to the ticket counter here, as he is a VIP, so he will be able to go straight away to the ticket counter. So he goes straight away to the ticket counter and he buys 100 tickets. He buys 100 tickets from the ticket counter. There are people standing here in the queue. He buys 100 tickets here in the queue. So it means the normal queue, the normal people who are standing in the queue, okay, for most of them, they are not going to get the ticket. Suppose there are 120 people here in the queue and there are 120 tickets left here. VIP came here directly to the counter and he bought 100 tickets. When he bought 100 tickets, so the chance of getting tickets for this 120 people will get reduced and only 20 people will get tickets. Remaining 100 people are skipped from this queue because of this VIP. They never served with the tickets. So this system eventually, when it means that here they are never, the orders are never executed here. Directly FIIs have executed the orders, price jumped from A to B and it has skipped the orders in between. Price jumped from A to C and it has skipped the orders in between. B never got executed. So price will act as a magnet and it will try to come back to that FVG zone to fill that orders. When it fill that orders, if market is in upward direction and creates that FVG, price is going to jump upside. If market is in downward direction and FVG is here somewhere else, price comebacks here, fills the orders, and market will tend to move further down in the direction. So this is what basic concept of FVG. So this is what I've explained here clearly in this slide. So here is the FVG. So this is how FVG is going to form when an aggressive institutional buying happens. So there will be a void between this candle 1 and this candle 3. So this gap is called as an imbalance zone. The missing liquidity, normal trading got skipped here. Normal trading is kept here, and whenever price goes further down this FVG, price will act as a magnet. It will come back to this FVG near to the 50% of the zone, and from here price is going to react and it is going to go towards that direction, in whichever direction the market is. Now let's understand what is bullish FVG and what is bearish FVG. Now you have understand the concept of FVG. Let's understand what is the concept of bullish and bearish FVG. So have understand now FVG. Let's understand the bullish FVG. Market is going in the upward direction. Market is going in the upward direction. Somewhere here, the market is going to form this imbalance zone, which is an FVG zone. Somewhere market is going to form the imbalance zone, which is FVG zone. So here the candle 1 high and the candle 3 low, we have a gap here. So this gap is called as an FVG. So as market is in upward direction, and if the FVG forms in the upward direction, we call this as bullish FVG. We call this as an bullish FVG. So whenever price further goes up, okay, this FVG will act as a magnet. Price will try to come to 50% of this zone, execute all the pending orders which are there here in the FVG area. When it executes, what orders it is going to execute? What orders are pending here when market is going in the upward direction? Buy orders are pending here. When market is going in upward direction, there will be no sell orders pending here, right? So there will be buy orders pending here, and when this buy orders get executed, the price will further move upside. So this is where we have to make our entry. Our entry will be at 50% of this FVG zone will be our entry. 50% of FVG will be our entry. And where will be our stop loss? Our stop loss will be below this FVG zone. Below this FVG zone will be our SL. So from here, our target will be minimum 1:2. Target will be minimum 1:2. This will be our target when you are playing with the FVGs. Now we have discussed the bullish FVG. Let's discuss about bearish FVG. Bearish means market will be moving towards downside, making lower highs and lower lows. Somewhere in between, you will see a FVG is getting formed. somewhere in between you will see a FVG is getting formed. Here candle 1 low and candle 3 high. If there is a gap, this gap is called as an FVG. And as this formed in the downward trend, so this is an bearish FVG. So price will move further down and this FVG is going to act as a magnet. Price will enter this FVG when price test the 50% of this FVG zone. Here is where we are going to make our entry. At 50%, we are going to make our entry and our stop loss will be above this FVG. In terms of bearish FVG, our stop loss will be above FVG. In terms of bullish FVG, our stop loss will be below FVG. So here we are going to make our entry. What will be our target? Our target will be 1:2. Our target will be 1:2. So this is how we are going to enter the bearish FVG, and this is how the bearish FVG is going to form in the downward trend. So here I've explained you clearly. So what is bullish FVG and what is bearish FVG? Now let's go back and see on the chart what is FVG, what is bullish FVG, and what is bearish FVG. So now we will understand what is bullish FVG and what is bearish FVG. Before to that, let's understand what is just normal FVG looks like. So as we discussed, normal FVG, we should be identifying 3 candles where the first candle high and the third candle low should have a gap. Okay, either it is a combination of green or red candles, or it is a combination of all 3 green, or it is a combination of all 3 red. It does not matter. Just identifying gaps between the first candle and the third candle. So this is called as an FVG. So now for us, this is an FVG. This is an FVG here. And let's identify one more FVG. So we have a gap here. So this is the first candle, and between this candle you have a gap here. So this is an FVG. From here to here, if you draw, this is an FVG. Okay, so here if you see, this is the first candle, this is the first candle, second candle, third candle, there is no gap. First candle, second candle, third candle, there is no gap. So usually you will not see gaps. Okay, so very rarely you will see gaps. So now here if we go on to the other side and see, so here this is the first candle, this is one candle, here this is the low of this candle, and this is the high of this candle. So here you have a gap. So this is treated as a EFVG. So here we can draw FVG. So this is also treated as an FVG. So likewise, wherever you have gaps between first candle and the third candle, okay, so those gaps you can mark as an FVG. So this is what FVG is all about, how to identify an FVG. Now let's come back and discuss what is bullish FVG. When market is moving upward, so we know bullish means market will move upward, bearish means market will move downward. When market is moving upwards, so it is going to create an FVG. So here, as we discussed some time back, so here this is the FVG we have identified. This is the first candle high and this is the third candle low. So if you draw here, so this is an FVG zone. So usually what will be our entry? 50% of this zone we are going to mark. 50% of this zone. So this is a 50%. So if market comes and test this zone, we are going to make an entry, and below this will be our stop loss, and here 50% zone will be our entry, and our target will be 1:2. Let's suppose if we are making an entry here. So our stop loss will be here below this FVG. Again, just keep 2-3 points below the FVG zone, and your target will be 1:2. So this is what 1:2. This is your first target. The second target will be 1:4. First target will be 1:2. Second target will be 1:4. After then, you can book some quantity and you can start trailing. So now in this case, price came tested top end of the FVG. It never came to the 50% of the zone. Second time it came, third time it came, fourth time it came. So it means that here the bulls are very strong. They are not allowing price even to come to 50% of the zone. In this case, you can enter here whenever you see an hammer like candle or full Moribos candle forming at the top end of the FVG. So you will enter here on this candle, and your stop loss will be below this zone, and your first target will be 1:2. Your first target is 1:2 here. So exactly we have achieved 1:2 here. This is our first target. This is our first target. Market exactly came here till 1:2. So this is how we have achieved our first target. And second target will be 1:4. That depends on where the market is. So if the market is almost rallied 200-300 points and still you cannot expect another 200-300 points in Nifty. So this is how you are going to trade the bullish FVG. So this is one bullish FVG we have identified. In the same chart, this is yesterday's Nifty chart. If you see, this is a consolidation zone. In this, when it is breaking the consolidation zone, here you have seen an FVG getting formed. This is the first candle, and this is the second candle, and this is the third candle. If you see this high and this low, there is a gap. So here you can mark this as an FVG zone. So this is a bullish FVG. Here price came, this is a small zone, price came and tested that 50%, and here you will make an entry. As this is a small zone, I will keep above only our entry. So below is our stop loss, and from here also 1:2 is your first target, as your stop loss is just 4-5 points, and 1:4 will be your second target. And market have given almost how much? 1:10. Okay, so this is what bullish FVG, how you have to identify and how you have to trade. Now let's see bearish FVG. So here now at the top end of this trend, if you see here, this is the first candle. So this is the low of the first candle. This is the high of the third candle. Here you have a gap between these two candles. So here you should draw an FVG here from this low to this high. So market came exactly, tested this FVG. From here only you got the rejection and market came down. So if you would have made an entry here, let's assume you are making your entry here and your stop loss is here just above this FVG. So how much you got in this trade? Again you got close to 1:10, 1:9.63. Okay, so this is how you have to identify the bearish FVG. So we'll identify one more bearish FVG. So towards the end of the market also, if you see here, so this is the first candle, and this is the second candle, and this is the third candle. So here you have a gap here. So this gap is an IFVG. So this can be combination of green and red candles. It does not need to be 3 red candles for bearish. It does not need to be 3 green candles for bullish. It can be a combination. If you see here, so here it is a red candle, green, green. So here you have 3 green candles. Okay, but here you have 2 red and 1 green. Here you have 2 red, 1 green. It can be combination of any candles, any color candle. So but for us, what we have to identify is the first candle low and the third candle high should have a gap for the bearish. For the bullish, first candle high and third candle low should have a gap. So now here we have identified this. Then price came, tested this zone. From here you see the rejection. In the same way, here also you have bearish FVG. So now this is the green candle, this is the red candle, and this is the red candle. So here between this candle low and this candle high, you have a gap. So here you can draw this. Price came into this zone. From here, price got rejected. Again, price came up, and from here only the price got rejected. While rejecting, again it had formed the another bearish FVG here. But here you are seeing a bullish FVG also, and here you are seeing a bearish FVG also. This overlapping of this bullish and bearish FVG, we will be studying following in the same session. So as we progress, we are going to look at this overlapping FVGs as well. This is a powerful concept that we will be discussing as we progress in this video. But do you think every FVG can be traded? Do you think we need to trade every FVG? Which FVG matters most? How we have to identify that? So there will be 3 patterns here I am going to tell you today. So where you will not find anywhere this. So there will be 3 kind of FVGs you will be seeing mostly in the market where the price is going to form. Generally, first candle will be small, second candle will be big, and third candle will be small. Or else, first candle will be big and second candle will be small and third candle will be small. Sometimes you will see first candle is small, third candle is small, and fourth candle is small. Sometimes you will see first candle is small, second candle is small, and third candle is big. You will see these 4 kinds of FVGs generally price is going to form. So all these are valid FVGs. There is a gap between this third candle low and first candle high. There is a gap between this first candle high and third candle low. Here also you have a gap. This is a FVG. This is also an FVG. This is also an FVG. This is also an FVG. And this is also an FVG. But out of this, which FVG you are going to trade? So the high importance we have to give is number 1 is this, number 2 is this is number 3, and this is number 4. This we have to avoid in most cases. If third candle is big, if first candle is small, second candle is small, third candle is big, we have to avoid this in most of the cases, 99%. Okay, 1% it might act, but 99% this will not really hold the price, which will not really bounce price. This kind of FVGs you will see mostly at top of your trend. At the top of your trend, if you see here, this is small candle, this is small candle, and this is a big candle. If you see here, and here you have a gap. So where it formed? At top of the trend. At top of the trend, you will see this kind of FVGs is going to form. Suppose if you enter here, price never came here. Let's assume you think that price came here and tested this FVG, and you enter here. What will happen? There is a small bounce, and again price came down. So this is not going to act as a strong FVG. So generally this 4th kind of FVGs is going to form at the top of the trend. How you will identify this, whether this is the top of the trend or bottom or middle of the trend? If you're able to identify this pattern, first candle is small, second candle is small, third candle is big, and here FVG is getting formed, it means that almost the trend is going to end for that given day. Trend is going to end. So this is where you will identify the trend also, and you will also eliminate this kind of FVGs not trading. And third FVG. Third FVG mainly you will be seeing in the sideways market. When market is sideways, so you are going to see this third kind of FVG where you will see first candle is small, second candle is small, third candle is small, and an FVG will get created. So this is a sideways trend. In the sideways trend, you will be avoiding trading FVGs because your risk reward will not sit properly. So inside, this is the third kind of FVG, that when this kind of FVG forms, it means that market will be mostly sideways. You are not going to get the better risk reward, but still you can trade this, but I would say this is 50-50. So when you are trading this FVG, suppose if you are trading with 10 lots every day, I would suggest to trade with 2 or 3 lots this kind of FVG. When first candle is small, second candle is small, third candle is small, I would say you trade with 2 or 3 lots if you are trading with 10 lots. If you are trading with 2 lots, I would say avoid this FVG or else trade with only 1 lot. Okay. So this is how you are going to filter this FVG as well. This fourth FVG indicates market is going to end the trend. Third FVG indicates market mostly goes sideways. You will not get proper risk reward, but very rarely you get big rewards. Okay, that is very rare. I would say 20% of the times. But if you avoid 80% of the time, you will be on the right side of the market. And the second FVG, I would say 90%, I would say 80 to 90% it is strong. 80 to 90% this is strong. 80 to 90% you are going to get a very good move. So first candle will be a big candle, second candle will be a small candle, third candle will be a small candle. Usually this forms at the start of the trend, or it forms when it is going to give a breakout of a consolidation zone. So at the start of the trend or consolidation breakout. When it is breaking consolidation, then it is going to form this kind of FVG. First candle will be a big, second candle will be a small, and third candle will be a small. If you see here, this is a consolidation, and where first candle is big, second candle is small, third candle is small. Do you have a gap here between these two candles? So this is where this FVG is going to formed, near the breakouts or at the bottom of the trend. So bottom of the trend, it is 50-50, and near the breakouts, 100% chances this kind of FVG is going to form. When this kind of FVG forms near breakouts or breakdowns, then this is going to give a good risk reward. So here your risk will be less and your reward will be more. So this can be a tradable FVG. And coming to first one. So first one usually forms 100% of times at the bottom of the trend, when there is a fake breakdown, when there is a fake breakout, and this is going to form at top or at bottom. When it is a fake breakdown, obviously this is going to form at the bottom. When it is a fake breakout, it is going to form at the top. It means that the trend is going to completely reverse. If you see the yesterday's example itself, What happened? So this is the first candle yesterday. It have given a fake breakdown here with this candle. Everybody would have went short, and then it formed a doji, and then second candle is a big candle and third candle is a small candle. Here it formed the FVG. So here market came, tested, this much time it have consolidated here near the FVG, and again it given a breakout upside. So this is how these kind of FVGs are going to form at the bottom or at the top. So this is at bottom yesterday. At the top, if you see here, we know when this FVG is formed, this is the mostly end of the trend. When the fourth FVG is formed, let me clear all this. When this fourth FVG is formed, you know this is the end of the trend. Small candle, and the big candle, this is almost end of the trend. So above this, market have given a breakout and stayed here for some time. And what happened? It given a breakdown here. When it given a breakdown here, this first candle is small and second candle is big and third candle is small. So is this formed at the top of the trend here? So here is the low of the first candle, here is the high of the third candle. So and this is where FVG formed. Price came, tested this zone and it came down. So yesterday itself we have seen this many examples on the chart. So how you have to identify the best FVG, which FVG you have to trade, how you have to identify FVG, bullish FVG, bearish FVG. Again within that we have 4 filters, 1, 2, 3, 4. Fourth one will form at the top of the trend. Third one will form between the trend or in the sideways market. Third one. And second one will form near the consolidation breakouts or at the bottom of the trend. But first one, it will form near fake breakdown or fake breakout at the bottom of the trend or at the top of the trend. If you understand this, then you will be able to trade FVGs properly and you will be able to capture good risk reward trading with this bullish and bearish FVGs. Hope you understood this now. Bullish FVG and bearish FVG. And what is that filter we'll be using? Suppose here is a bullish FVG, it is formed. So let's assume this is a bullish FVG. What is that filter you will be using? The 50%. Why we need to generally enter at 50%? This is where big players will enter by a discount and then they will make a price move upside. If it is a bearish FVG, let's assume this is a FVG zone and this is 50% of the zone. When price comes up, big players are not going to sell at premium. Big players will always sell at discount. Okay, they will sell high and they will buy low. That is why on FVG you should mark 50% of the zone with the Fibonacci or any tool that you use. Mark this 50% of the zone. When price comes there, buy there. And for bearish FVG, mark the 50% of the zone. When price comes here, sell here. That is how big players are going to do. Big players are going to buy at discount and sell at premium. This you have to understand. So this is what the ultimate filter that will be using premium versus discount. So big players sell in the premium and buy at discount, and that is where you have to mark that 50% zone of any FVG. So now let's look another advanced concept. So this you would have not heard anywhere else. This is called as BPR. What is this BPR? BPR stands for balanced price range. BPR stands for balanced price range. So how you are going to identify this BPR? This is very interesting. Observe this. So we are going to discuss this and we are going to see on the chart as well. Sometimes a bearish FVG and bullish FVG will get overlapped. So that overlapping area is called as a BPR. So it means that, let me take green here. This video will be little lengthy, but you don't need to go and check any other videos to understand smart money concepts and to trade confidently using FVGs. No need to read any book or go anywhere on any other channel and take that bits and piece of information. This is a complete video of smart money concepts. It will be lengthy and worth watching. Okay, so now, as I said, BPR will get formed when a bearish and bullish FVG will get overlap. That overlapping area is called as an BPR, balanced price range. So price is moving like this. Just price is moving, and here somewhere you will see an FVG is getting formed. Here this is an FVG. And suddenly what happens? Trend will reverse here. Trend will reverse here, and here you will be seeing a bearish FVG also. So now here bullish FVG and bearish FVG both are overlapping at one place. This is a bearish FVG and this is a bullish FVG. Both are getting overlapped at one place. So this overlapping area is called as a BPR, balanced price range. It means market moved aggressively in both directions. Market have moved aggressively upside and it created this imbalanced zone here. It created this imbalanced zone, the bullish FVG. Market moved downward direction and it create and bearish FVG. This is an imbalanced zone. But when these both FVGs overlapped each other, now price is balanced. So this BPR area, now the price is balanced. When they overlapped, earlier it was imbalanced, now the price is balanced. This is a very high probability zone. Price will act as a magnet and it will pull back to this double imbalance zone. So here it is an imbalance, here it is an imbalance, both overlapped each other and we calling that area as a BPR, and here is where both FVGs are balanced, but still the pending orders are here. Still the pending orders are here, as this is a very high probability zone, as both FVGs overlapped each other. If price comes from here to the top to this FVG zone, price is going to give a very good down move here. Okay, price is going to give a very good down move. There can be another case. So this is one case. So this is bearish side. We are seeing when the overlap happens, when price comes here, it is going to give a down move. Now let's see on the bullish side also. Let's see on the bullish side. Now price is coming from the upside here. Price is coming from the upside to the downside, and it created a bearish FVG here. After creating bearish FVG, immediately I have seen a pause candle here, and next candle is a big green candle. Again I see another green candle. So here what happened? Here again this FVG is breached. When it is breaching, it created another FVG here, and this now both are getting overlapped each other. So this area is called as a BPR, balanced price range. Now price went upside. Now here two imbalanced zones are there, bearish FVG and bullish FVG. When price comes to this imbalanced zone, again you will get a very strong move upside from this zone. This is a high probability reversal zone. So BPR is like two magnets stacked in the same spot. This is one magnet and this is one magnet. They got stacked in the same spot instead of one. So the pull will be stronger. When two magnets are at one place, how the pull will be? The pull will be very much stronger. Price will definitely come back to this range, and it is going to give a bounce from here. So that is what I've explained here. So this is an advanced gap theory, balanced price range. So overlapping area between bearish FVG and bullish FVG is called as a BPR. Price will act as a magnet in this double imbalance zone, and price is going to get pulled to this zone, and whichever direction the price is going to bounce from here to that direction. If it is coming from top, it will bounce to the top. If it is coming from bottom, it will further go down. This is how this is going to act, BPR. So let's see on the chart. Now we have seen the theory, but let's come back and see on the chart where is this area formed. So if you see here, yesterday's chart itself is the example for everything, that the concepts that we are going to discuss today as part of the smart money concepts. So suppose if you see here, price came down. So here this is the first candle low and this is the third candle high. Do you see a gap here? This is a bearish FVG. And now from here price reversed aggressively and went upside. When it is going upside, what happened? Here this is the high of the first candle, this is the low of the next third candle. So again here bullish FVG is formed. Here it is bearish and here it is bullish. So both FVGs are getting overlapped each other. It means this is a BPR. This area can I call as BPR. What happened? Price came here. How many times it have taken support here? Almost 7 to 8 times. Price came into this range. Price was able to break this range and go downside. It is highly impossible for the price to break this zone and go downside unless and until there is some news or some event happening. It might break this, but as of yesterday there was no news, no event, nothing. So price taken support. In news events, no indicator, no zones, nothing will get work. Okay, it's just the event. The price will move mad upside or downside based on the news. So when there is no news or no events, so these are the high probable reversal zones. So price multiple times it have taken support here, and from here price have bounced like anything. If you made an entry here, your stop loss will be below this zone. You would have captured all of this move yesterday. And along with this, you also know other concepts of FVGs. So here we have one FVG. This is the second concept of FVG. We have discussed 4 kind of FVGs. This is second kind of FVG, consolidation breakout FVG. So even if you have not known this concept, at least you would have traded with this concept. You also know the first concept of FVG, the first model, so where it is going to form at the bottom. At least with this you would have entered long. But now you also know the advanced concept called BPR. When you see this kind of FVGs overlapping each other, bearish and bullish FVG, you should not leave trading those FVGs where the big risk reward you are going to get in this kind of FVGs. Now here if you see at the day end also, here this is the bullish FVG and here this is the bearish FVG. Both are getting overlapped at one place. This is BPR. Both are almost getting overlapped at one place. This is a BPR. And from here, now again if price comes to this zone, then price is going to reject. In case if Monday market opens gap up above this zone, then this is invalidated. But price when comes down, this is going to act as a support if market opens gap up. But in case if market opens flat or gap down, price comes back to this zone, this is going to act as a very good resistance. From here price is going to reject and it is going to go further down. So now you understood the concept of BPR. So here I will show another BPR here. So this is candle low, this is candle high. Okay, this is also getting formed at a swing high. Okay, so this is bearish FVG. This is bearish FVG. And immediately you have seen the bullish FVG here. Immediately you have seen the bullish FVG. Now here these two are overlapping each other. So we call this as a BPR. Two are overlapping each other. We call this as a BPR. And price came down. Now price when comes up, here you have two BPRs. Here in this structure you have one BPR. In this structure you have one BPR. So now this zone is a very strong zone. If price opens gap up, price comes back to this zone. Here from here you're going to get a bounce. If price opens flat or gap down, price comes back to this zone. From here you are going to get a reversal down move. So mark these zones on your chart and see how it is going to behave on Monday. Okay, so now we have discussed the concept of BPR as well. So now this is what the BPR is all about, the bearish and bullish. Okay, when price comes here, price is going to bounce from this zone. So this is what we discussed. So again, all BPRs can be considered as inversion fair value gaps, but not all inversion fair value gaps are BPRs. What is this? We are going to discuss now. Let's assume this is a bullish FVG. This is a bullish FVG. And this is the 50% of that zone. When price comes back to this 50% zone, what you will do? You will make an entry here. You'll make your entry here. And you'll keep SL below this zone. And from here your target will be 1:2. Your target will be 1:2. But sometimes what will happen is price will break this zone. Price will break this zone. When price breaks this zone, so let me clear out and draw properly. 1 second. So here is a bullish FVG created. This is an FVG. This is an FVG. I would say bull. This is an bullish FVG. So you'll mark 50% of your zone here. 50%. When price comes from top and when it touches this 50% of the zone, here you are going to make an entry and your SL will be below the zone. And when price moves upside, your target will be 1:2. But sometimes what happens is price, instead of testing and reversing here, price will directly give a breakdown here. A red candle will close under this bullish FVG. When red candle close under bullish FVG, this FVG is no more validated for the upside. This FVG will now become a resistance. This FVG will now become a resistance. Now when price comes from the down and test this FVG from the downside, this will act as a resistance and price will further go downside. When it tests this 50% of the zone, here you are going to make an entry. Your SL will be above this FVG and your target will be 1:2. So this concept is called as an IFVG. It is nothing but inversion fair value gap. This is called as an inversion fair value gap. When a bullish FVG zone is broken by a red candle, angle filled by a red candle, so this bullish FVG is now going to act like a bearish FVG. From bull side, it will turn to the bearish side. So this concept is called as an inversion FVG. In the same way, now market have created a bearish FVG. So let's assume this is a bearish FVG. Generally, we will take entry when price comes here to the 50% of the zone. Here will be our entry, here will be our SL, and our target will be 1:2. Our target will be 1:2. But sometimes what happens is, instead of testing this 50% of the zone, price will directly close above this zone. Price will directly close above this bearish FVG. When price close above this bearish FVG, now this bearish FVG is going to act as an bullish FVG. When price comes back from the top and tests this 50% of the zone, price is going to react from here. We are going to make our entry here. Below this will be our SL and our target will be 1:2. This concept is called as an IVFG. When a bullish FVG is broken by a single candle, then that bullish FVG will turn to be a bearish FVG. When bearish FVG is broken by a single candle, that bearish FVG will turn to the bullish FVG. It will change its character. Nothing but it will change its character. That polarity is going to flip. Bull side it will become bear side, bear side it will become bull side. Hope you understood this concept simply. So let's see, we will see on the chart if we can find this. Let's see if we can see this on the chart. Okay, so I would see here one example. So this is a bearish FVG here. Here you have the bearish FVG. Let's mark this zone. Let me mark. I have marked this bearish FVG now. What happened? Price came here price tested this, it have not tested the 50%, and this candle have closed above this zone. This candle have closed above this zone, above this bearish FVG. Now when price came down, what this FVG was acting like? It was acting like a support. From here, price have moved upside. This is how bearish FVG will turn to be a bullish FVG. So this is bearish side concept we have seen. Let's see the bull side concept. Let me check for the bull side FVG. Yeah. Here, yeah, no gap. Let's see any of the previous days. This inversion you will see very rarely, inversion FVGs, but when that happens, then that will be a good opportunity for us to trade. So almost market is sideways. No. Here you see a BPR also. This is where market have made a bottom and reversed from here. If you see, this is the BPR. This is the bearish FVG, and here market also formed the bullish FVG, and these two were getting overlapped at one place, and from here only market taken support and made a bottom and moved upside. So this is where we have taken our entry also. Bullish FVG. Okay, let's take this as an example of bullish FVG. So here you have this bullish FVG. Here you have this bullish FVG. Let me extend this further right. Okay, this is the bullish FVG. Price came, taken support, given a bounce, and slowly this candle have broke down this. So when it broke down, this should become a resistance. Let's see whether it become a resistance. If you see here, price came, tested this, and this was acting like a resistance for some point of time, and price broken up, came down again. This was acting as a resistance, and finally when it breaking outside here, it created the FVG again when it is breaking this resistance. Now this FVG was acting like a support. Now when this FVG was broken, again it acted as a support. Exactly here it taken a support, and market have bounced upside. So this is how bearish and bullish FVG are going to change their characters, and this concept is called as an inversion FVG. Hope you understood this concept. So this is how it was bearish FVG and green candle closed. Now this will turn to be a bullish FVG. Okay, so this is what the inversion FVGs is all about. The failure of a bearish FVG will become a bullish FVG. The failure of a bullish FVG will turn to be a bearish FVG. So, and we have discussed all these concepts here. What is bullish setup and what is bearish setup? Okay, standard FVG, inversion FVG, BPRs, all these concepts we have discussed today. So this table is a cheat sheet for you. 3 setup types, bullish and bearish version of each. Standard FVG, basic 3 candle gap, inversion FVG, a filled gap that flipped, and the balanced BPR, two overlapping gaps. Combine any of these with the premium discount filter, whatever we have discussed previously. Combine with that and you have the complete entry framework here. So you can take a pause here, take the screenshot of this table. Genuinely it will be useful so that you can apply these concepts while you are trading in intraday. So hope this will help you to make your trades better from next week. Just observe these concepts initially. Don't trade with your real money. Just do some paper trading and then just start with the real trading once you are confident about these trade setups. Thank you everyone for watching this video. We will meet again in the next concept, in the next new video, so that you will be able to learn many concepts by subscribing to this channel. If I have to make any new videos on any new concepts, please comment down under this video so that based on those comments, whichever comments I see most, I am going to make my next video based on your comments. Thank you everyone.